It's countdown to the Monetary Policy Committee decisions announcement. Thank you for staying tuned. I'm Chimeze Obi Iwagu. The Central Bank Governor, Godwin Emefiele, will in a very short while from now announce the decisions of the Monetary Policy Committee at today's meeting. In the meantime, here is what the committee did at its last meeting in May. The committee voted to hold all policy parameters. The MPR was unchanged at 11.5%. The CRR was retained at 27.5%. The asymmetric corridor was maintained at plus 100 and minus 700 basis points around the MPR, and the liquidity ratio retained at 30%. Well, with me is Professor Ken Ife, development economist, and of course the head retail investment at Chapel Hill, Durham, Ayodeji Ebo. Thank you very much, gentlemen, for staying on.
Thank you.
Okay, let's look at some of these policy options that you did mention in our earlier program. What policy options now do you think are available to the MPC at this meeting? Ayodeji.
Thanks. I think looking at the scenarios that would play out, the best option, I think, would be to maintain status quo. When you look at CBN is aware that there are other instruments that can be used to control the interest rates, because for most of the investors, they will be concerned about interest rates. CBN have also realized that there's little or nothing they can do regarding inflation. Inflation is more of cost push, and it lies with the fiscal authorities. So I know the CBN will also, or the MPC will also be encouraging the fiscal authority to accelerate implementation of policies, creating also enabling environment so that there can be more participation from private investors in the economy, given the revenue challenge of the federal government. So beyond that, I don't think that there will be any rational reason to increase the interest rate. So MPR has been reduced by 200 basis points this year alone, and we still know that the growth, though may look positive, is still very fragile. So there will be no major reason to increase the interest rate at this point in time. And also looking at the other scenario of reducing the interest rates, that would, yes, there's no direct impact of money supply on inflation, but would also fuel inflation and would increase interest rates and may crowd out more the private sector.
Okay, so what is your view on the relevance of the MPC in view of your hold position? And do you think that maintaining a status quo at this time is a sustainable strategy for monetary policy? Okay,
yes, I think what for most monetary policy are to provide guidance, which I feel should also be a major focus. In terms of the interest rate, even at one of the last MPC meetings, the CBN governor also alluded to the fact that the MPR is becoming a bit redundant based on other measures that are available. So, yes, there may be no, as we're expecting, that there may be no shift in the interest rate, but it's also good to also use that to provide a guidance around the interest rate, the expectation, also around even the exchange rates. So that guidance always helps investors, because when you look at other clients, it's based on the views that is being proposed by the committee that drives what is happening in the financial market. So I would say there should be more focus in terms of providing guidance on most of these parameters, even if there are no major decisions. And what we also see is more persuasion in terms of there's a limit to what the monetary policy can do. We can see at the last meeting, the CBN governor outlined significantly a lot of the intervention funds across different sectors of the economy. But when you also look at it, it's a fraction So yes, it's very laudable, but it's still less than 10% of our total GDP. So there's a limit to what it can achieve. Yes, it's helping and it's yielding a result, but we also need to see what the fiscal authorities need to come up with a very strong implementation policy.
Okay. All right, Ayodeji, well, I can see that the Central Bank and the Monetary Policy Committee are all set to tell us what the outcome is. Well, just before the Central Bank governor starts talking, let me ask Professor Ife. Now, ensuring price stability is a core mandate of the Central Bank. How do you think the CBN has fared in keeping with this primary mandate of maintaining price stability in Nigeria? When we look at its peers, talking about South Africa, Ghana, Kenya, we see that their inflation rates are still within their target bands, but Nigeria has moved way above.
Well, it could have been worse, to be honest with you. It could have been worse. These economies that are performing far better than us are not hostage to the kind of crisis that we are having. And in fact, one is that South Africa economy is very, very diverse. They have their manufacturing component of the GDP much, much higher than Nigeria. In fact, vegetable, you wouldn't believe that they're supplying for 40% of vegetables to Japan. Their mining is a big component of their GDP. Our own is insignificant. So they have a balanced economy. So other things are bringing money. If oil was there, if oil wouldn't cause as much disturbance. But our oil is 90% of the forex or more. So that small thing distorts everybody. And exactly the insecurity, the level of insecurity, fuels speculation. People are worried. People have all left all the northern zones, have come down to Abuja, and they're going to be looking for where to put their money. They want dollar. Safety. And safety and security is so paramount.
All right, Prof. All right, Prof. Well, we can see that the Central Bank Governor Godwin Emefiele is now addressing the press. Let's listen to him. We seem to be having some audio issues there. While we seek to correct that anomaly there, let's get back to Prof. Well, Prof, you are talking about the inflation trajectory here in Nigeria. But then let's look at the unemployment data, which is currently at 33.3% in fourth quarter of 2020. So how important, is this unemployment data as a lagging economic indicator in the decision-making policy?
The unemployment is at the heart of our challenges, because unemployment connects to direct relationship to these hostilities that you are having. Why are the people being recruited faster than anything you can think of into terrorism and banditry and all of that? It's because they don't have any job. So if somebody is working and productively engaged, they will not have time. They will have more money than probably what they are going to get in what is being offered to them in terrorist-related activity, plus the fact that their life is at risk. So we haven't got that alternative. Neither has the education sector provided us enough match between the skills that the employers need. If can't employ, some employers are complaining they can't even get the quality workers that they need. Yeah, they're all pouring out of education. So, you find people saying that they are unemployable. So it's not even about unemployment, that they are unemployable to a great extent. But that is not the end of it. Entrepreneurship hasn't pervaded the structure, the educational structure, for people to begin to think from the word go, I am going to employ myself. I am going to do something to benefit this economy. So it's not about going to government to ask for that. And they've told you they don't have the job. The president has said it. They don't have any job in the bureaucracy. Neither should we have people go to bureaucracy. So it's a dire situation. The unemployment is an embarrassment. It's a huge embarrassment. And it connects to all the challenges that we are having. If we increase, output will increase if you get more people involved in agriculture and agribusiness, not just in the production, but also in the beneficiation, in the value addition, and all of that supply chain integration. But we'll continue to suffer. Our economy will continue to suffer so long as we have this high level of unemployment.
Yeah, but unfortunately, the recent report by World Bank now talking about a lot of youth migrating and seeking asylum outside Nigeria. I mean, how do we increase output when we have able youths migrating?
Well, the technology is really the easiest way to improve output. And if you connect the young people with agri-tech, fintech, all of this technology, mechanization, improve this, they will connect to this. But if the image you are selling to them is carrying a hoe and machete and going into the thick bush, you're on your own. You know, so and young people can do aquaculture in the city. They could do it in the peri-urban areas. They can do all kinds of livestock and poultry farming and vegetable and all this aquaculture and horticulture. So it doesn't have to be all of them living in the rural area and then they'll tell you about infrastructure. It's not there in the rural area. Wherever they are, there is substantial agribusiness that they can do. They can add value across the value chain. They can collect what has been produced anywhere and everywhere and add value to them. Cassava carries 60%, 90%, 70% water. Once you dry it, then you can go any direction. It could be exported. It could be used to produce bioethanol twice more than you can produce when it is wet. And young people will connect with all of those, processing all kinds of things that we eat and making sure that they are presentable and quality. They are better able to bring quality on what we are producing than relying on the traders. The traders will simply pick the raw produce and then ferret it down to Lagos or Port Harcourt. But they're not. Many of the traders are just not interested in value addition. Get our young people in that space, and they can make business for themselves.
Okay. Ayodeji, now for most part of the year, the external reserves have sustained the downward movement regardless of the development in the crude oil market. Why are we not seeing the positive impact of the oil demand recovery on the reserves? And how will this shape the MPC stance on the exchange rate policy?
Okay, thanks. I think we need to remember that there's OPEC implemented a quota which we flouted, and there was a penalty for a particular period, which reduced what we could produce. So that capped the revenue, because when you look at revenue, it's price times quantity. So yes, with the quantity was capped, and when you look at production, around 1.4 million barrels per day that we've been doing. So that impacted on the revenue, but the price helped at the point in time. But we also need to look at, even based on what is also even available as for use under the subsidy issue is another discussion for another day. But what the CBN has been trying to do is to ration the external ration the reserves. Yes, though it has both its pros and cons. So in terms of investors' confidence, most foreign investors would invest or would bring in funds based on available liquidity. But also from the CBN angle, it's also trying to preserve this. This is the level of what I have, I can't supply. So what we typically see in the market is that CBN would, any supply, any spot order would also be followed by forward orders. I think an average of 150 days. So if you are bidding for $1 million, CBN will give you $100,000 and give you the remaining $900,000 forward rate over 150 days based on a fixed amount. So I think what the CBN most times have not been discussing much of FX issue at the MPC meetings. Most of the major decisions that have been taken on FX have been outside the MPC meeting. But we feel it's also something that should be focused on. Those are major indicators. Unemployment, which Prof also spoke about, are major indicators that should also be discussed at MPC meetings so that it can help shape and see a direction of where the economy is going and what will be done regarding.
All right, Ayodeji, let's get back to the central bank governor now speaking.
Relative to the preceding month's figure of 45.0, that remained below the 50.0 index point threshold. The committee welcomed the sustained monetary and fiscal stimulus to revamp the domestic economy and hoped that the distribution of vaccines to subdue the pandemic will continue unabated. Committee noted the continued moderation in headline inflation year-on-year to 17.75% in June 2021 from 17.93% in May, the third consecutive month of this decline. The decrease was attributed to a marginal decline in both the food and core components to 21.72 and 13.09% in June 2021 from 22.28 and 13.15% in May 2021, respectively. The MPC noted that though headline inflation remained well above the ceiling of the central bank's 6 to 9% corridor, it expressed optimism that the current interventions by the CBN in various sectors of the economy will further depress inflationary pressure as output growth improves and the negative output gap closes. On the performance of the monetary aggregate, the committee noted that broad money supply M3 declined to 2.02% in June 2021 compared with 2.99% in May 2021. This development was largely driven by a slowdown in the growth rate of net domestic assets NDA and net foreign assets NFA. Net foreign assets contracted by 3.65% due to the contraction of the foreign assets holdings of the central bank, as well as non-interest, primary mortgage, and microfinance banks. The marginal decline in net domestic assets (NDA) reflected the slowdown in aggregate credit net, which decreased to 4.3% in June 2021 from 4.79% in May 2021. Accordingly, aggregate credit at the end of May 2021 stood at 24.23 trillion naira compared to 22.68 trillion naira at the end of December 2020. This represents year-to-date increase of 1.55 trillion naira. Under the bank's development finance initiatives, the bank granted 756.51 billion to 3,734,938 smallholder farmers cultivating 4.6 million hectares of land, of which 120.24 billion naira was extended for the 2021 wet season to 627.51 farmers for 847,848 hectares of land under the Anchor Borrowers program. For the agribusiness and small and medium enterprise (AXMEs), the sum of 121.57 billion naira was disbursed to 32,617 beneficiaries, and for the targeted credit facility, 318.17 billion naira was released to 679,422 beneficiaries, comprising 572,189 households and 107,233 small and medium scale enterprises. Under the National Youth Investment Fund, the bank released 3 billion naira to 7,057 beneficiaries, of which 4,411 were individuals and 2,646 to small and medium enterprises. Under the Creative Industry Financing Initiative, 3.22 billion naira has so far been disbursed to 356 beneficiaries across movie production, movie distribution, software development, fashion, and IT verticals. Under our 1 trillion naira real sector facility, the bank has so far disbursed 923.41 billion naira to 251 real sector projects, of which 87 were in light manufacturing, 40 in agro-based industry, 32 in services, and 11 in mining. As regards the 100 billion naira healthcare sector intervention facility, so far we have disbursed 98.41 billion naira to 103 healthcare projects, of which 26 are pharmaceutical companies and 77 hospital services. Similarly, the sum of 232.54 billion naira has been disbursed to 5 beneficiaries under the CBN's Healthcare Sector Research and Development Intervention Scheme for the development of testing kits and devices for COVID-19 and Lassa fever. As regards the National Mass Metering Program, 36.04 billion naira has been disbursed to 17 meter asset providers under 9 discos for the procurement and the installation of 657,562 electricity meters. As regards the Nigeria Electricity Market Stabilization Facility NEMS2, CBN has released 120.29 billion naira to 11 discos to provide liquidity support and stimulate critical infrastructure investments needed to improve service delivery and collection efficiency. On money market development, the net liquidity position and interest rates in the economy reflected the impact of the bank's liquidity management operations. Accordingly, the monthly weighted average interbank call and open buyback rates rose to 16.87 and 16.39% in June 2021 from 15.95 and 16.16% in May 2021, respectively. Committee noted the weak performance of the equities market despite the recent increasing patronage by domestic investors. The all-share index decreased by 1.28% to 37,947.18 on July 16, 2021 from 38,437.88 on May 31, 2021. Similarly, market capitalization decreased by 1.3% to 19.77 trillion naira on July 16, 2021 from 20.03 trillion naira on May 31, 2021. The MPC noted that capital adequacy ratio and liquidity ratio both remained above the prudential limits at 15.55 and 41.3% respectively. The non-performing loans ratio NPL at 5.7% in June 2021 showed progressive improvement compared with 6.4% in June 2020. The committee, however, urged the bank to sustain its tight prudential regime to bring non-performing loans below the 5% regulatory benchmark. Committee noted the marginal increase in the external reserves, which rose to $33.8 billion on July 22, 2021 from $32.78 billion as at June 2021. Our outlook. The overall outlook for both the global and domestic economies remain clouded with downside risks despite the upbeat forecast for a speedy recovery. These risks include lingering uncertainties surrounding the path to the termination of the pandemic as new and deadlier strains of the virus continue to pose a significant threat to the efficacy of the COVID-19 vaccines. In addition, the uneven distribution of vaccines across the globe is undermining the realization of the current forecast. Capital flows to emerging market economies remain uncertain as the pace of price development in the advanced economies pick up, while the US Fed and other major central banks have given indications that the current rise in inflation is transitory and may not require policy adjustments. Inflation is confronted with a significant upside risk. This may result in an early return to monetary policy normalization with adverse consequences for financial system stability. Available data and forecasts for key macroeconomic variables for the Nigerian economy suggest a broad improvement for the rest of the year. This is hinged on continued progress with the containment of the pandemic as well as ongoing monetary and fiscal support. As a result, the Nigerian economy is forecast to grow in 2021 by 3.45%, CBN estimate, 3%, Federal Government of Nigeria estimate, and 2.5% IMF estimate. Committee's consideration. The committee noted the gradual recovery in output growth following positive growth in the first quarter and improving PMI in subsequent months, expressing confidence that the second quarter output result will show further improvement. The MPC carefully assessed the options confronting it in the short to medium term, analyzing downside risks to growth and upside risks to inflation. It commended the continued effort by both the monetary and fiscal authorities as well as public health agencies in stemming the pandemic and its impact, thus returning the economy to a path of recovery. While the economy has been gradually reopening, members noted that the pandemic was far from over and therefore continued to hinder the recovery. It thus urged the Presidential Task Force on COVID-19 to intensify efforts towards the procurement of more vaccines to ensure that herd immunity is achieved in Nigeria. MPC was concerned about the broad level of insecurity across the country, noting its impact on business confidence and overall economic activities. It noted the persistent insecurity in key commodity-producing areas and urged the federal government to intensify security surveillance in farming communities to ensure an uninterrupted farming activity. Committee members expressed optimism about the likely moderating impact of the forthcoming harvests on food prices, as this would contribute to the ongoing broad reduction in headline inflation. The CBN will continue to release maize from its strategic maize reserve directly to feed millers as part of its strategic response to address rise in food prices and moderate the price of maize across the country. Members further noted the contribution of poor infrastructure to rising domestic price levels, reiterating their call to the federal government to prioritize investment in public infrastructure such as improved transportation networks, power supply, and telecommunication facilities. Funding for such projects, the committee noted, could be sourced through public-private partnership as well as the issuance of diaspora bonds. It emphasized the complementary role these bonds will play to boost foreign exchange supply, improving accretion to reserves, and easing the exchange rate pressure. Notwithstanding the moderate decline in market indices, the committee noted that the equities market remained in a good place, indicating sustained investor confidence in the Nigerian economy. MPC applauded the continued resilience of the banking system in the face of severe shocks to both the domestic and global economies. Members noted management's effort in maintaining a reasonably low level of non-performing loans ratio, even though aggregate credit moderated slightly. The committee encourages the banks, Nigerian deposit money banks, to extend more credit to consumers and firms to enhance consumption and production activities necessary to strengthen our recovery. The committee members noted the persistent reduction in remittance of oil revenue to the Consolidated Revenue Fund, stemming largely from rising levels of cost under recovery and other obligations, particularly to joint venture contracts. The committee thus urged the government to continue to explore additional sources of non-oil revenues, as this would reduce the overdependence on a single revenue source. Members applauded the efforts by the federal government to encourage the use of gas in motor vehicles and the payment for conversion of 1 million premium motor spirit petrol PMS driven vehicles to gas driven to reduce overall cost of PMS consumption. The committee encouraged the participation of private in private sector initiatives to develop and expand modular refineries, while it frowns at cross-border smuggling of PMS. Committee also noted the increased contribution of the non-oil sector to government revenue in recent times, which reflected the gradual diversification of the Nigerian economy and reduced reliance on crude oil export proceeds, and calling for increased support for the non-oil sector in the country. Overall, members were confident that the bank was taking the right steps towards the restoration of macroeconomic stability, while noting the downside risks to growth and the upside risks to price movements. Committee's decision. At this meeting, the MPC was delighted that inflation had begun to trend downwards, while output growth had remained positive. Committee, however, was of the opinion that there was a need to continue to put in place policy measures that will further and faster drive down inflation, while at the same time accelerate output growth to levels above population growth rate. Whereas the arsenal at its disposal had almost become fully exhausted, MPC believed that there is the need to continue to use those tools that had been adopted so far, even in a more aggressive manner. MPC therefore encourages the bank to continue to use its existing administrative methods to rein in inflation by the use of its discretionary CRR policy to mop up liquidity from the banking system as the need arises. Committee also encouraged the bank to continue the use of its intervention mechanisms to deploy funds to output-stimulating and employment-generating sectors of the economy, such as the Targeted Credit Facility, the AXMIS, agriculture, and manufacturing sector. In the committee's view, the current situation neither gives room for tightening, as this will halt output growth, nor loosening, as this will exacerbate inflationary pressure. On tightening, MPC feels that whereas this will limit excess liquidity available to attack the foreign exchange market, it nevertheless feels that tightening will reduce money supply and thus inhibit the ability of deposit money banks to create credit that is needed to stimulate manufacturing output, which could also help to moderate prices. On loosening, whereas MPC feels this should transmit into market interest rates, which could improve the ability of obligors to repay their loans and reduce NPLs. It nevertheless feels loosening would not only exacerbate inflationary pressures, but this would increase negative real interest rate of return and discourage investments in the domestic economy. Based on the above considerations, the MPC made the decision to hold all parameters constant, believing that a hold stance will enable the continued permeation of current policy measures in supporting the recorded growth recovery and macroeconomic stability. The committee thus decided by a unanimous vote to retain the monetary policy rate at 11.5%. In summary, MPC voted to 1. Retain MPR at 11.5%, 2. Retain asymmetric corridor at plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 27.5%, and 4. Retain the liquidity ratio at 30%. I'll now switch over to the second aspect, which had to do with recent developments in the foreign exchange market. Distinguished members of the press, ladies and gentlemen, in continuation of the press briefings for the July 2021 MPC meetings, I'd like to provide some updates and policy decisions regarding the operations of some aspects of our foreign exchange market in Nigeria. As we all know by now, Nigeria has been dealing with the effects of 3 significant and simultaneous global shocks, which began around the first quarter of the year. First, there was the onset of COVID-19 pandemic, which claimed millions of lives, destroyed billions of livelihoods, and continues to have a devastating effect on current global economic activities. Second, given the sharp deceleration and complete stoppage in global economic activities at some point, we also witnessed a protracted and steep decline in the price of crude oil, which contributed to the largest share of our foreign exchange reserves. Indeed, as of 20th April 2020, the price of crude oil fell below $0 per barrel as producers were forced to pay buyers for overwhelmed storage facilities. Third, given that no one knew the depth or duration of the pandemic, many foreign investors withdrew massive amounts of funds from the emerging market economies, including Nigeria, and reinvested them into safe haven assets like the US Treasuries. The Institute of International Finance estimated that investors withdrew over $100 billion in emerging market portfolio equity and roughly $20 billion in emerging market portfolio bonds in the wave of the pandemic. Nigeria suffered its share of these withdrawals during that time, although we are beginning to see some of these investors return back to Nigeria. In the aftermath of these shocks, we saw daily turnover in our foreign exchange market fall from almost $300 million per day in the first quarter of 2020 to about $40 million per day at the height of the pandemic. In light of various efforts and initiatives by the CBN, we have seen this number rise to as high as $150 million per day in July 2020. Despite the aforementioned FX supply pressures, the demand for foreign exchange has not abated, thereby putting additional pressure on our reserves. To avoid further depletion of the reserves, the CBN took several countervailing actions, including prioritization for imports of critical raw materials and providing ample supply for businesses and personal travelers. While these have been turbulent times, we are happy to note that these measures have been positively decisive in helping us maintain a healthy level of reserves despite these exogenous difficulties. In total disregard of the difficulties that the bank is facing in meeting its mandate of maintaining the country's foreign exchange reserves to safeguard the value of the naira, we have continued to observe that stakeholders in some of the subsectors have not been helpful in this direction. In particular, we have noted with disappointment and grave concern that our bureau de change operators have abandoned the original objective of their establishment, which was to serve retail end users who need $5,000 or less. Instead, they have become wholesale dealers and illegally in foreign exchange to the tune of millions of dollars per transaction. Despite the fact that Nigeria is the only country in the world today where a central bank sells dollar directly to bureau de change operators. Operators in the Nigeria's bureau de change segment have not reciprocated the bank gesture to help maintain price stability in that market. Whereas the bank has an understanding with bureau de change operators that they make a small margin from sale of the US dollar allocated to them per week, they have reneged and become somewhat greedy, recalcitrant, with abnormally high profits from these sales, while ordinary Nigerians have been left to feel the pain and therefore suffer. Given this rent-seeking behavior, it is not surprising that since the CBN began to sell foreign exchange to bureau de change, The number of operators has risen from a mere 74 in 2005 to over 2,700 in 2016, and almost 5,500 BDCs are at today. In addition, the Central Bank of Nigeria constantly receives nothing less than 500 new applications for BDC licenses every month. And we therefore begin to wonder, what is in this business that everybody must be in it? Rather than help to achieve the laudable objectives for which they were licensed, the bank has noted the following unintended and unfortunate outcomes. 1. Avalanche of rent-seeking operators operators only interested in widening margins and profits from the foreign exchange market, regardless of prevailing rates in the market. 2. Gradual dollarization of the Nigerian economy with attendant adverse consequences on the conduct of monetary policy and subtle subversion of the cashless policy initiative of the Central Bank of Nigeria. 3. Prevailing ownership of several bureau de change by the same promoters in order to illegally procure foreign exchange multiple times from the Central Bank. 4. Numerous and repeated financing of unauthorized transactions with foreign exchange procured from the Central Bank of Nigeria. 5. Indeed, we have evidence that several international organizations, embassies, regrettably, and development finance institutions, I repeat, regrettably, operating in the country, patronize BDCs through illegal forex dealers to fund their local operations in further and flagrant contravention of our foreign exchange laws and regulations in Nigeria. Our examiners are currently looking at the books. We have reports that indict development finance institutions, embassies, international finance organizations who, instead of selling their foreign exchange into the recognized investors and exporters window, have resorted into operating with illegal forex dealers in flagrant contravention of our laws. And we will deal ruthlessly with the Nigerian banks who have acted as collaborators with these illegal forex dealers. We will deal with them ruthlessly because they have allowed their banking and payment system infrastructure to be used to facilitate this illegal dealing in foreign exchange. As for those foreign organizations involved, we will report them to their regulators. We will write to those organizations seeking their understanding and that they must desist. If they seek to operate in Nigeria, they must go through the right channels through which they must procure either foreign exchange or procure naira for their domestic operations. For avoidance of doubt, such transactions should have been done at the transparent investors and exporters window. These unintended outcomes have placed an unsustainable and enormous financial burden on the CBN and our limited foreign exchange. The CBN sells $20,000 to over 5,500 BDCs per week. This amount translates to about $110 million per week and about $5.72 billion per year. This is a scarce resource, and Nigeria's central bank, the Nigerian government, cannot continue to allow this unwholesome practice to continue in Nigeria. This is a huge hemorrhage on our scarce foreign exchange reserves and cannot continue, especially because we are also concerned that bureau de change have become a conduit for illicit financial flows. Indeed, the facts abound that BDCs have turned themselves into agents that facilitate graft and corrupt activities of people who seek to conduct illicit funds flow and money laundering in Nigeria. And we will go after all of them. Throughout this meeting of the Monetary Policy Committee, we extensively debated these matters and independently with each member of the committee exhibiting accurate and deep understanding of the issues at stake. After these exhaustive and comprehensive deliberations, the management of the Central Bank will, with the full support of the committee, reach the following decisions which will take immediate effect. A. First, the Central Bank will henceforth discontinue the sale of foreign exchange to bureau exchange operators. B. The bank will no longer process or issue new licenses for BDC operations in the country. This stoppage extends to all licenses being currently processed regardless of the stage of that processing. C. The bank would henceforth channel a significant portion of weekly allocations currently meant for BDCs to commercial banks to meet legitimate FX demand for ordinary Nigerians and businesses, whether for small-scale imports, medical bills, educational expenditure, personal and business travels, or any other legitimate needs as prescribed by the CBN's foreign exchange manual. D. All commercial banks in the country will, with immediate effect, create a dedicated teller point in designated branches for sale and disbursement of foreign exchange to customers who desire FX for legitimate purposes. For emphasis, the public should note that once a customer provides the basic documentation to purchase foreign exchange, all banks must immediately, either on demand or within a stipulated time frame, sell foreign exchange to the customer. Any customer who does not receive foreign exchange along these lines must report this to their bank, and where they are unsatisfied with the resolution, they are required, indeed they must, contact the CBN on our toll-free line number 070-02255-226. I repeat, 070-02255-226, or email cpd@cbn.gov.ng. Repeat, email cpd@cbn.gov.ng to lodge a complaint with details of the bank's transaction. In closing, let me note, very importantly, that these measures are not intended to be punitive on anyone or any group. Rather, it is meant to ensure that the CBN is better able to carry out its mandate in an effective and efficient manner, which guarantees preservation of our scarce commonwealth and that our hard-earned financial system stability remains intact to and for the benefit of Nigeria and all Nigerians. I thank you for your attention.
Thank you, Governor of the Central Bank of Nigeria. And that was a communique of the 280th meeting of the Monetary Policy Committee of the Central Bank of Nigeria, held today, the 27th of July, 2021. And as is usual, we'll take a number of questions. We have a number of correspondents here, and some others have also given us their questions. And
Well, the Central Bank Governor Godwin Emefiele just finished with the decisions reached at today's meeting of the Monetary Policy Committee. And of course, the committee, as expected, decided to retain all policy parameters unchanged, with the MPR remaining at 11.5%, CRR at 27.5%, asymmetric corridor maintained at plus 100, minus 700 basis points, and the liquidity ratio retained at 30%. More importantly, I mean, for the first time, and just as my guest, Ayodeji Ebo, had mentioned earlier, for the first time, the central bank is talking about the foreign exchange market at this meeting. Ordinarily, they take any position outside the meeting, but this is happening in today's meeting, talking about the FX market. Well, let me get back to my guest, Ayodeji Ebo, the head retail investment at Chapel Hill, Durham, and of course, Professor Ken Ife, who is a development economist. Thank you very much, gentlemen, for sticking on there. I mean, this is one in a million meeting. I mean, this FX market has been an issue, for the country. What strikes you most from what the central bank governor had talked about, particularly regarding the activities of the BDCs? Ayodeji, a quick one.
Thanks, and I think happy that at least at the MPC meeting there was something major for us to look forward to take away, which is the development in the FX market. I think what the decision the CBN is taking is based on the examination. They have more preview information to what is happening within that market, and the CBN rightly highlighted that when you have the percentage of increase in terms of application for licenses, which is currently you have about 5,500 BDCs. So what the CBN is doing is trying to go through a channel that they will have control over. But the implication of this, we expect to be knee-jerk reaction. We'll see that significant movement at the parallel market. Because the BDCs are also a major part of the supply to that market. So we will see that major reaction in terms of depreciation of the naira at that market. But depending on how the CBN is able to implement the use of the commercial banks, that would determine the extent of appreciation that we would see when things normalize. It's a big shock, and I know we're still trying to digest some of the implications and its impact on the market.
Hi, Professor Ken, what's your own thoughts there?
Is a shock, though, because there are always two sides of every coin, and I can hear these weighty allegations from the governor, and they're really, really weighty.
Very weighty.
And he's taking the decision. But even when a Supreme Court takes a decision, you have to go back to the Supreme Court and marshal some evidence and ask them to review their own decision. So I would say that let's obey the decision, let's comply with it, let's digest what the intelligence that the governor has, and let's see what the supervision and monitoring activities are. There may be 10 out of the 5,000 that do not deserve to be closed, so we don't know. So there may be some point in the future where the CBN itself may be minded based on some other information that was not available at the time, decide to review its own decision. So it's not unlikely that it could happen in the future. But I think the allegations are very, very weighty indeed, and the disturbance and disruption that is caused to the economy is horrendous. That is not to say that the commercial banks are saints. Of course they are not. And then we also have issues, our own issues with commercial banks. After all, we have AMCOM that was set up, and they have 6 trillion naira that they have pushed out to go and public money to rescue the commercial banks, and they've only recovered less than 1.5 trillion. So, even though these banks have actually helped us a lot, they've brought more than the $200 billion into the economy since 2005. So, but what I'm saying is that, you know, these are work in progress.
Well, let's just see how the markets will react to this. Just as Professor Ife said, it's really weighty allegation, and we'll see how this plays out in a couple of weeks. Thank you very much, gentlemen, for being part of this program. Unfortunately, that's where we will leave it for now. Thank you. And that's it on the program.
Thank you very much for having me.
Thank you for joining us. I'm Chimeze Obi Iwagu.